Now, looking at the perspective, not just a digital asset, but the perspective of your work in 2025, it will also depend on the macroeconomic condition, financial condition, inflation, interest rates, economic growth globally in the US and in Europe. This is what's going to discuss now Alessandro Tentori, Chief Investors Officer in Europe of AXA Investment Managers. Alessandro, welcome again to QUANT.
Yeah. Good morning, everybody. It's a bit weird to discuss such an important topic in English in front of a respected Italian audience, but we will try to make our best. Now, the topic I would like to discuss today is about the relationship between inflation and debt. We live, and we will live for the next 5 to 10 years in a world where we have a higher level of debt, particularly public debt, and a higher level of inflation compared to what we are used to. If you take, for example, the average inflation rate that we have seen in the 20 years leading up to the great COVID shock, the average was somewhere around 2%, sometimes below 2%. And from then onwards, the average has been significantly higher. And expectations for inflation in the coming years, at least what we see from the markets, what we see from the various surveys, tell us that inflation is not going to converge to 2% anytime soon. So it is important to understand, the behavior, the relationship between those two important variables, because they will influence the way that we think about the world. They will influence the way that we construct portfolios. Let me switch forward to an important aspect, which is the stability of debt, the sustainability of debt. This is taken from the European Union, but I think it will work equally well for every kind of debt. What can we say about tomorrow's level of debt? Well, tomorrow's level of debt is simply today's level of debt, plus an important variable. One is the nominal interest rate, which is applied to that level of debt, and the other is nominal growth. And you can see this in R minus GT, which is nothing else but the level of interest less the level of growth. Imagine that we have today a high level of interest rates, as we do compared to the past. And you can see this, for example, in the Italian public debt statistics, where the cost of servicing the debt has increased simply because interest rates have increased. Similarly, the cost of servicing US Treasury debt has increased because US Treasury yields have increased. That's fine. But what can we say about the sustainability of that level of debt in the long term? Well, it depends really on where we think nominal economic growth will be. Simply because the higher growth is, the more taxes are collected, and the easier it will be for the issuer of debt, in this case the state, the government, to service that debt. This is straightforward, I would say. The point of interest is that nominal growth is the sum of inflation and real growth. This is where inflation comes in the discussion of debt sustainability. So you can have a high level of inflation, which boosts economic growth, nominal economic growth, and hence makes it easier for the issuer of debt to service that debt. This is one way where inflation could be positive for those who have issued a lot of debt. So it's like a transfer of wealth between the creditor and the debtor. It's not always positive for the creditor. Imagine you are the taxpayer, you are citizens, as we are, and we have a high level of inflation. Our spending power is eroded. We all feel poorer, but at the same time, of course, the level of national debt compared to GDP goes down, which is what we have seen in the past 3 years, in particular due to the high increase in inflation in this country. So we need to be cognizant of the fact that inflation has an important role to play when it comes to the discussion of long-term debt stability. Now, what is debt? And I apologize for my slides being in Italian because I thought previously I would have to speak in Italian, but now they tell me it is in English. So it's fine, it's fine. It's probably going to be easier to understand what I mean by that. The backbone of macroeconomic theory when it comes to debt, public debt in particular, is the Ricardian equivalence, which is a way of saying no matter which instrument, which way of applying public finances to the economy you choose, the result is going to be the same. So independently of the instrument chosen, whether taxation or issuance of debt, the result will be the same in terms of economic aggregates in the long run, simply because families, companies, economic agents more in general, internalize the information they get. They are rational, so they internalize the information they get about a government's decision to use public finances for economic purposes, for political purposes, and so they will adapt their own level of consumption, level of investment, and so on and so forth. So whether today the government chooses to issue bonds or to increase the level of taxes, it is immaterial to the outcome. If you think about it, well, if I tax you today, then of course you will have less disposable income, consumption will go down. If instead I, as a policymaker at government level, issue bonds to finance spending, I, as a rational economic agent, will think that, well, in order to pay back this debt, tomorrow taxes will increase. And so I adapt my consumption decision equally. And so it is totally relevant. If you want, it's the analogous situation to the Modigliani-Miller theorem, which says that the structure of capital is irrelevant when it comes to the valuation of a company. It's the same logic that is behind it. Now, let's switch to inflation. And I apologize for, this is the last formula that I will show today, but it is important, I think, to discuss inflation in the context of the broader modeling framework that we have today. This is the new Keynesian model in its very simplified structural form. And it basically is composed of three equations. One equation is the so-called Phillips curve. This is where inflation enters the discussion that central bankers have when it comes to the economy. And you can see that the inflation today is just a function of the output gap and of inflation expectations. Inflation expectations are very important, and we will discuss them briefly on the next slide. Then you have the new Keynesian investment savings curve, which is just to say that the output gap, so the difference between today's growth and potential growth, is a function of expectations about that output gap, and in particular about interest rate. So the higher the interest rate, the lower will be the level of investment in the economy, and the slower will the economy grow. And then the Taylor rule, which is a way to close, as we say in mathematics, to close the model, which basically says that the level of interest rate is a function of the output gap and of the inflation expectations, the inflation gap. So the higher is inflation, the higher will be interest rates. The higher growth, the higher will be interest rates. This is a really simple formula, simple framework that we use in finance, that we use in economics to describe the steady state behavior of any economy in the world. Now, coming to the theory about inflation, I think it's important to reconcile the fact that we have two types of inflation. Of course, inflation is the same. Prices appreciate or go down independently of the source, of course, in the same fashion. The qualitative nature of inflation is always the same. But we need to differentiate between a demand-driven inflation shock and a supply-driven inflation shock. Now let me shed some light on those two points. So demand-driven inflation is the inflation that we are used to, that we understand as inflation. This happens when there is too much growth. So when an economy that is supposed to grow at 1% potential grows at 3%. Or to make an even better relevant example is when an economy like the United States that has a potential growth of 2% grows closer to 3% for 3 years in a row. There you have demand-driven inflation, simply because there is too much demand for goods and services in the economy, and this excess demand needs prices to go up in order for equilibrium to be restored. This is a good way, to rebalance the model, and it's a simple way to rebalance the model because it allows the central bank to operate in this framework. It's a symmetric shock. Growth and inflation go up, growth and inflation go down. So you as a policymaker, imagine you are at the European Central Bank, you don't have a dilemma. You either cut interest rates when the economy is too slow and inflation is too low, or you increase interest rates in the event that inflation proves to be too fast and growth is excessively fast. Now, if we turn our attention to supply-driven inflation, that's a bit of a different type of inflation. And we have seen that type of inflation in the post-COVID era. We had bottlenecks, we had supply shocks, we had supply chain disruption. Remember all these things maybe 2 to 3 years ago? And in contrast to demand-driven inflation, supply-driven inflation is a nasty type of inflation because we do not have a unified theory to deal with it. It is true, it has the same effect on debt, on national government debt, as demand-driven inflation. And we have seen this in the data. Debt to GDP in Italy collapsed, down from 160% to 135% because of inflation. So exactly the same mechanics as I showed you before, except that this time around, the policymaker, the monetary policymaker, the central banker, does have a hell of a hard time to deal with it because it's an asymmetric shock, which means that growth increases and inflation decreases, or growth decreases and inflation increases. So what do? Do you increase interest rates because inflation is high, or do you cut them because the economy is growing too slowly, because unemployment is rising? And this is particularly true for the Federal Reserve, which has a dual mandate, as you know. So they have full employment and price stability as the two pillars of their strategy. And if we were to face such an environment, it would be really difficult to choose for them, which is the best strategy to apply. And make no mistake, we will see this dilemma evolving over the next month simply because we have a trade war, simply because there are tariffs which have been announced worldwide by the Trump administration to the previous commercial partners. And the result of a trade war is always slower growth and higher inflation, and hence the discussion about asymmetric shocks. Now, let me turn to expectations, which is another point that's very important when we talk about inflation and debt. Expectations in macroeconomics, in economic theory, typically have the form of either adaptive expectations or rational expectations. Well, adaptive expectations are very naive expectations. If inflation is high today, it will be high tomorrow. If inflation is low today, it will be low tomorrow. It's like saying, if it rains, it will rain tomorrow, okay? The problem with that is that they can create nasty cycles of explosive behavior. There is no equilibrium, so they're very difficult to reconcile with the holy grail of macroeconomics, which is equilibrium economics. Sometimes when you have adaptive expectations, you don't reach equilibrium as a result. So let's leave them aside for a while. Rational expectations are very different. They're a bit more complicated. Rational expectations have been introduced in macroeconomics only in the 70s by a gentleman called Robert Lucas. And they basically say that we are very smart. Each and every one of us understands really well how the macroeconomy works, has instant access to all the data, and can make perfect decisions about the future based on a unified modeling framework, the one that I showed to you, the new Keynesian model. And so, in that sense, we can always forecast, inflation, debt, economic growth in the best possible way. There's no way of making mistakes, and everybody collapses to equilibrium. So we have this type of expectations right now, and on the basis of that analysis, we have created models for central bankers that allow them to be really, really credible and to commit fully to the operational targets that they do have. So there is no room, whereas in the adaptive world, we do have room for error, we do have for disequilibrium and so on. In the current modeling framework, when it comes to debt and inflation, there is no room for big deviations. And then, of course, we do have always, when it comes to inflation, the risk of being confronted with exogenous shocks. That could be geopolitical factors, it could be other markets. Think, for example, of commodity markets. Oil prices go up and down, food prices go up and down, industrial metals go up and down. So there is always the chance that something will derail this equilibrium process in time. And of course, base effects. Base effects are simply the statistical result of computing inflation as a rolling window over 12 months. So if one price category is low in 12 months, it will have a positive effect. If one price category is high in 12 months' time, it will have a negative effect on inflation. Let me come to the current data set. So what are we seeing right now in the broader discussion about debt and inflation? Well, what you see here is the aggregated central bank balance sheet. These are the major central banks in the world. Okay, it's indexed to 100 in 2004 in blue. And in red, you see, for the same central banks, for the same currency areas, you see the money supply. A few observations on that topic. Now, first of all, the red line is actually nothing else but the amount of money that is necessary for an economy to function well. This is the minimum amount of money that we all need, such that we can do transactions, we can do investments, we can do consumption, and so on and so forth. When the gap between central bank balance sheets and that minimum amount of money is very wide or is widening, we are creating excess liquidity. Excess liquidity translates sooner or later into inflation. So we can already now, we can say that we are in a situation of extremely ample liquidity, which does not bode well for the stability of prices. Furthermore, we can see that the increase in this liquidity in 2020 due to the COVID shock is significantly larger than the increase in liquidity that we had in 2008 as a response to the great financial crisis, simply because at the time we still did not have instruments like quantitative easing at our use. It was invented for the Federal Reserve and for the ECB only a year later. It was already in place, of course, by the Bank of Japan, but it was not palatable for politicians to utilize that instrument at the time. The second thing I would say is that even now that this excess liquidity is coming down simply because central bankers are not utilizing any longer quantitative easing as a strategy, as a tool, as an instrument, we're still higher than we were previous to the COVID shock. So it's an important fact that liquidity is extremely ample. This liquidity can qualitatively be central bank liquidity that is given to the banking sector, like 2008 to 2019. And it has very little effect on inflation because the banks filter it. Look at Italy, for example. Banks were taking a lot of liquidity from the central bank. They were not granting loans to firms and to households because they needed to repair their balance sheets, their own balance sheets. So we didn't see that much inflation. But come 2020, liquidity is given in terms of fiscal liquidity in addition to quantitative easing, and immediately consumers start to spend that liquidity, and it becomes immediately T+1 inflationary. So we need to differentiate between debt that is inflationary and debt that is not inflationary. This is the point. At the moment, we have a lot of debt that is extremely inflationary, and this is, I'm afraid to say, going to continue as we pursue very, very expansionary fiscal policies around the world. I know this is not meant to scare you. This is just inflation in blue, inflation in the 70s in the US, and in orange, it's the current inflation. And it's moved around so that the peak in June 22 is at the second inflation peak of the 70s. There are some analysts, some economists who claim that we're now in the same situation, that we are going to move higher in a couple of years and to reach new highs in terms of inflation simply because of what I have said, simply because there is too much debt around, and this debt is proving to be extremely inflationary for the system. And so this might be something to understand, something to analyze, something to try and avoid if we are policymakers. We certainly don't want to go back to a world where we have 10-20% inflation simply because this starts to be a bit of a drag on economic growth in terms of its price stability effect on GDP. And then there is another example of inflation, and this is German inflation in the 20s. So just to try and understand what it means to have a lot of debt and a lot of inflation, think about this. At the eve of World War I, with $1 you could have bought 4.8 Deutschmarks. That was the currency exchange rate. By 1923, with $1 you could have bought 4.8 trillion Deutschmarks. That's the effect of inflation on the currency. That's the amount of inflation that has been generated by several shocks and several bad decisions. First of all, the shocks, the repatriation shock, the reconstruction shocks due to Germany losing the war, of course. That was the expected inflation up to 1921. And then you have the assassination of Walter Rathenau, Germany's foreign minister, and at the same time the annexation of the Ruhrgebiet by France and Belgium. And this was the unexpected part of inflation. This is when inflation really took off, and this is where you had this hyperinflation situation. Also because at that time, the Reichsbank, the German central bank, was not operating well, didn't understand that, didn't see that huge amount of debt. That yes, it was having initially a positive effect because it was deleveraging implicitly German companies, but as soon as it started to become an explosion of inflation, explosion of debt, it started to have a really negative effect on economic growth. And so it's really important to keep that in mind. We should avoid at any cost this type of explosive behavior, this type of de-anchoring of inflation expectation. Before we conclude, just another point. Debt and inflation, it's the financial fragility hypothesis by Hyman Minsky. Hyman Minsky, as you know, is a prominent New Keynesian economist. And he was basically saying that when we have too much debt and all this level of debt is really short term, so we have a lot of refinancing to do, refinancing risk increases, and so rating risks, and we have lower liquidity, and there is a lot of companies that enter the market without a sound business model, but simply because there is a speculative argument behind the business, then we have financial fragility, which takes actually 5 stages before it really starts to be seen in the marketplace. So that's another issue that we have to deal with. We have to prevent all this liquidity to become inflationary and all this to change the behavior of our collective business making. We need to stick to the fundamentals, and of course this refers to speculative assets like, for example, crypto assets, but also to other things. We've seen this in the early 2000s when a lot of companies were issuing equity simply because they were called abc.com. And without any other reason than that. We didn't know what they were producing, we didn't know how to value them, but we were buying them with the proposition that we would be able to sell the share at a higher price tomorrow. And this is really speculative. Let me conclude. Too much debt. Too much compared to what? Any level of debt can be sustained as long as economic growth is strong, as long as you can pay interest. Currently, everybody says that that the gold has gained 45%. No, it's the dollar who has devalued. If you change the narrative, it becomes really ugly. The dollar, the main currency in the world, has devalued by 40% in 5 years against gold because there is too much debt. Don't forget this. Try and see things the other way around. New currencies, maybe. Inflation will bring new assets, new currencies to us. And don't forget, we think that inflation and debt have entered a new regime, one where inflation is going to be higher than 2%. I'm not saying 20%, but higher, and this accumulates over the years. And unfortunately, that will be higher as well. And these are risks to financial fragility. Thank you very much for your attention.
Thank you. Alessandro Tentori, thank you so much. Just a quick couple of questions. The first comes from the audience, because Alessandro, we know that everyone is looking at inflation, that in the US, everyone thinks that the Trump's policies, from commercial tensions to immigrations, are influential on inflation, so inflationary. If you look at the curve, the long part of the curve, apparently, the Fed reduced, but the curve apparently is out of control. And the question from the audience is that if you look at the Fed's recent minutes, they show that its stance is to reduce its balance sheet and reduce excess liquidity. And the question is there a chance that this will balance the expected increase in inflation that the Trump's policies could import into the system?
It is certainly a force that might put a lid on inflation, but I'm afraid to say that the other forces, be it imported inflation through the trade war, be it higher wages and salaries, because let's not forget that the Trump administration is regulating immigration flows into the economy, and already now we feel from the data that the US economy has a shortage of labor, and so this wage spiral which will be exacerbated even further. I'm afraid to say that these are stronger forces and they will compensate for the effect.
Interesting, because consensus today is on one cut in interest rates in the US in 2025. Is there a case for not a descent of interest rates, but a hike in interest rates?
There's always probabilities around, but let's not forget that only a couple of months back in October there were 5 to 6 rate cuts in the curve. So the market has already adapted to this new scenarios. Let's wait. On the 19th of March, the Fed will reconvene, and this time around they will publish their new summary of economic projections, where they will have to increase growth projections, inflation projections, and probably also the rate trajectory. So there will be a discussion about for how long to keep the current interest rate level and whether or not to change the stance altogether.
So we will look carefully at that and the dot plot, as you know, so the prediction of the member of
Definitely.
the Fed. But if we look at Europe, the situation is even more confusing because, we just heard from the central bank governor of Italy, Fabio Panetta. He's saying, inflation is going down rapidly, we have to adapt, we have to do not look at the neutral rate anymore because it's imprecise. And so translation for the audience is we might go below 2% by the summer or something like that. And then Isabel Schnabel, another influent member of the ECB, coming out saying, no, we should start talking about the end of reducing interest rates. So what's happening? What do you expect from the ECB?
The ECB will try to accompany other policymakers in order to stabilize the structural issues of the Eurozone. Of course, some of these are very long-term structural issues, like, for example, the banking union, the capital markets union, which cannot be solved by any means with a 25 basis point rate cut. That's much bigger than monetary policy. But monetary policy has to play its role and provide time to politicians, especially in the Eurozone, where time is so important and politicians are so slow.
And lastly, we're talking about digital assets, and one of the questions from the audience is, do you think that digital asset may be one of the solutions also to the debt problem? We heard in the morning, you know, the case of San Salvador buying 1 Bitcoin per day and so on, but what do you make in your equation of digital asset in the future?
Asset is the right word to use. I don't like to talk about cryptocurrencies because currencies have a completely different set of requisites that they have to fulfill compared to, let's say, Bitcoin. So asset is the right word. Now, I have a hard time because there is no unified model about the valuation of this asset. How do you value a Bitcoin? We know how to value a bond. We know how to value an equity, more or less. We know how to value other things. But it's very difficult for us to understand how to value a Bitcoin other than the fact that it might appreciate tomorrow. And so this is why people are buying it. And this is the only variable that we can use, and it's a speculative variable. So this is why I have a hard time in seeing Bitcoin, for example, overtaking traditional currencies as a reserve, as a world reserve currency.
Oh, okay. And lastly, very final question, Alessandro, because one question from the audience is, given the scary curve that you showed, the double peak of inflation going back to the 70s, and sometimes when you put different graphs on the same scale, it's scary. And one of the questions from them is, do you think it's likely that 2025 will turn out as a 2022 years? And I think you remember how bad was 2022 for markets, bond and equities as well.
I don't think so, because the drivers of inflation now are mainly demand drivers, demand-driven drivers. And especially central banks are now better equipped in order to face a higher inflation phase than they were in 2021, when they didn't really understand, safe to say, they didn't really forecast inflation to pick up. And they're much better equipped with instruments than they were in the 70s, when they had absolutely no clue of what's going on.
All right, Alessandro Tentori, thanks
Thank you very
again,
much.
CIO, AXA Investment Managers.